Are you ready to take your first steps towards financial freedom by investing in property? Whether you're a first-time investor or you've started your portfolio but need some help continuing to grow, 2022 REB Buyer's Agent of the Year and Rising Star finalist Lachlan Vidler and his team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take your next step in growing your portfolio. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment property. Visit atlaspropertygroup.com.au to book in your discovery call absolutely free of charge.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. In an interesting time for Australian property, you're no doubt all connected in with what's the headlines getting beaten up right now in relation to property. Feels like it's back to the future. 2 years ago, very similar commentary as we entered the COVID-19 pandemic. We didn't know how long it was going to last, and I guess we're still in it right now. There's still some significant hangovers as a result of it, both from a health perspective, but from an economic point of view. But the media like headlines, the media like flux, and the media like to beat up drama. And we're so interconnected these days on our smartphone devices, and there's information everywhere that you can't turn anywhere without seeing something related to property. And it is the great Australian dream, property ownership. And property investorship, I'd like to add as well. So you're going to see a lot more moving forward as we try and get some sense for the economic environment that we're currently in, what it means, how it's all going to work, whether or not it's a good time to invest in property, and how you can go about making the right decisions. But I wanted a bit of a history lesson today, and I am a student of history. One of my pastimes actually is collecting old history books, but that's not really for this. But you can look towards the past to actually telegraph what may happen in the future. And you only need to think about the European war in Ukraine at the moment. There's a lot of lessons there from previous European wars of 80 years ago and 105 years ago, 108 years ago. Who would have thought that history would be repeating itself on the battlefields of Europe? But that's the way it plays out. And I think as we move into a rising interest rate environment compounded by a lot of macro and microeconomic factors which are complicating the property markets, we should look back in time and see what happened last time around. We went into a interest rate cycle. So sort of focus for today's chat. I've been musing about this in the background for a little while. I must admit my numbers on this are a bit light. I've done a bit of reading on it, but there's other people who invest their full-time job into understanding these dynamics and helping their clients prepare the future. One of them is Paul Glossop. He's director, founder of Pure Property Investment. He's going to give us a bit of a history lesson. I'm going to sort of challenge him to see whether or not history will repeat itself. And if it does, it's probably not going to be a bad thing. Paul Glossop, how you going?
Very good, Phil. Visions again of you sitting by your mantelpiece with your leather-bound books. Many of them, I don't doubt, are dusty, blowing them off with a glass of cognac and reciting Churchill post and pre-war is something that I can envisage.
Yeah, well, people that know me, you know me, people that know me could actually probably visualise that. I could be smoking my pipe with, I'd actually put on my smoking jacket with leather patches on the elbows by my library, musing.
Probably inhaling your daughter's bubble machines and things like that. I know you don't smoke, you're not a smoker, but
I'm not a smoker.
You find an apparatus to inject in there.
No, well, just quietly, I feel like having a small hot toddy on Sunday night. So I actually made one, and I was actually doing a bit of what do you want to call it? Sort of backyard operation on infected fingers of mine. So I needed to numb the senses a little bit. So I poured myself a stiff bourbon, and I put a little bit of amaretto in there as well as a bit of lemon juice, and it was actually really quite nice. So I can actually see myself drinking that same said drink over some history books and history. Well, the victors normally write the history. If you want to sort of go down that pathway and you look at sort of economic history, I am a collector of biographies, and I don't mind the occasional economic biographer, the story of some of the great economists of time past, even those less great economists of time past who are sort of narratives of global markets and how things work. And I must admit, I've been in property for a little bit as a journo, longer than as a property investor. I'm a bit confused with it all. So I think looking to the facts, looking to the primary sources, trying to telegraph what's happening today and what it means for the future is probably smart. So I don't know. You've got out your history books, Paul, and looked at the last time around there was a rising rate cycle, and it's about 11 odd years now, I think, since we've seen interest rate hikes. And I think there's about 1.5 million Australians who have mortgages who have never seen an interest rate hike. So, people are a bit jittery at the moment, and I'd like to sort of say, hey, everyone just relax a bit. That's normal for interest rates to go up. And if you've been listening to the Smart Property Investment Show over many years, you would know that smart investing means that when rates do go up and circumstances change and you get seismic shifts and changes in habits and behaviors of markets and people, you got to hold the line. That's good investing. So what do the history books say, Paul?
Well, mate, I guess the first thing that I wanted to just point out to the listeners and that I'm still struggling to get my head past is when you referred to back-end tidy up and numbing your fingers. Just everyone needs to probably rewind about 4 minutes and listen to that. I still got a visual in my head. Anyway, we'll pass on from that part. But look, we've talked about this offline a few times over the last probably week or two because, there's a few things that are happening on your end from an actual portfolio review from a financial perspective. And, this is probably one of the more important times people need to consider what they're doing with their finances from a fixed versus variable, from an equity redraw versus structures, et cetera. Because to be fair, the last 12 years have been essentially just keep it variable and the market will take care of the cash position. For the most part, you need to work with a good broker and a good brokerage team to be able to release the actual amount of equity that's available, and different policies will allow that. But the actual interest rate side of things, it's been a really interesting one. And the reality, if we're going back, and to your point, mate, you're a student of history for the most part. And the beauty about, and this is a really interesting part, is we had I think you and I did a webcast the best part of 2 years ago now on the breaking of the pandemic and the start of our lockdowns. And we literally did a walk through history on the previous 5 recessions back to the late 70s, early 80s, and basically said, well, what happens to the property market in Australia when we go through big economic turmoil? And here's the reality and the facts of this, and this is really interesting, right? If people want to get confidence into what the history will tell us as to what will happen, is that out of the last 5 interest rate cycle, not necessarily interest rate cycle, but the last 5 recessions that we did have, the property market over the following 5 years, over those last 5, increased by an average of 33%. And guess where we are sitting right now, Phil, across the Australian property market since we did that webcast? We're sitting at about a 32% average annual growth position across Australia. Go figure, like how close and uncanny that actually is to what exactly happened the last 5 recessions that we had in the following 5 years. Now, granted, this has happened in 2 years, and we've had obviously a lead up that's been far quicker with stimulus, with cheaper money, with access, etc. But we're looking at the same data to say, well, what's going to happen when we go through an interest rate cycle that's going to see increases? And the reality is, we're recording this a couple of hours before RBA is going to hand down its decision, and it's either going to be today or it's going to likely be next month on the first Tuesday, if it's not today, and we'll see the first start of this interest rate cycle increase. Fixed rates have increased about 6 months ago on the most part, and they're sort of hovering, depending on 2, 3, 4, 5 year fixed rates. You're probably seeing anywhere plus or minus 4% for fixed rates, but variable rates are sitting plus or minus 3% at the moment. And the consideration that we have to have now is that it's not just, is our money going to get more expensive? Because it is. But what happens to the Australian property market, and why does money get more expensive? And the reality is, if I look back to the 2002 to 2008 cycle, where we saw money go up essentially over that 6 years incrementally from a base that was lower all the way up, is that the average increase in Australian property prices in that 6 years was 50%. Now, I'm not suggesting we're going to see another 50% increase in value in Australian property prices between now and 2027, 2028. However, if we consider what that and why that happened, is it comes down to why we're seeing inflation now in March quarter is over 5%, is that we're seeing a strong economy. And essentially, they're the things that we have to take confidence in, is that interest rates don't go up because the actual economy is flailing and is suffering. Interest rates go up due to the fact that we're seeing increase in value in goods, services, and essentially everything that supports the economy. The one thing that I see is quite different now versus the last time we saw interest rate increases, though, is that we actually have more savings in our bank accounts on average per capita than we've ever had before. We're further ahead on our mortgage repayments per capita than we've ever been before based on a monthly timeframe concern or consideration. We're seeing the fastest rate of rental growth as far as dollar value that we've seen in over 15 years. So increase in income from rents for investors is also coupling with all this. So I guess I'll rattle off those three major things there to say, well, yes, on an average $1 million loan, if you've got $1 million in debt and your interest rate goes from 3% to 4%, then yeah, pretty simply, you can equate that to 10 grand more in interest repayments that you'll be equivalent that you'll have to pay per year. However, when you couple in all the other factors that sit there in the background, the reality is we expect in the next 6 to 12 months, we're going to see interest rates increase. We're going to see a new norm, but we're also going to see the actual flow of money in and the buffers that people have in place on average to actually give a good buttress to exactly where we think we'll land. So it's going to be a very soft landing. The major markets that are going to get affected are the ones that are higher inflated. And they are Sydney, they are Melbourne, they're probably parts of Hobart, little parts of Canberra as well. But there are markets out there that are still extremely affordable and will still thrive throughout this interest rate cycle increase.
Yeah, we'll observe. And one thing that is sort of heightening this focus right now is the federal election, which is happening this month. And this is a moment in time. You remember, probably is a long-term game. Who's actually in power? Consequence to what happens with property, but it's not going to be that significant. The inherent engine that is Australian property can out-survive and outlast most governments without them damaging it too much or amplifying it too much. So, this is not really a political thing, but that's the environment we operate within right now, and it's fueling a lot of the headlines that you're seeing as we sort of near the election. But affordability is a really key point. I want to have a chat about that because, looking back in history, affordability has always been part of the narrative. So let's break that down. Let's go to a break beforehand. Stay with us, back in a moment.
Creating wealth through property investing starts with getting the right finance in place. At Finny Mortgages, our brokers specialise in investment loans. We know the ropes to get even the most complex deals approved fast. With easy access to over 50 lenders, we have the know-how and connections to get better rates, improve cash flow, and release equity fast. So if you're looking for a mortgage broker that gets property investment, book in a call with a Finny broker now. Head to finny.com.au, that's finni.com.au today.
Welcome back, everyone. It's Phil Tarrant, host of the Smart Property Investment Show with Paul Glossop from Pure Property Investment. Now, Paul, affordability is the catchphrase as we enter the election, and some people would think, oh, really? I didn't realise that housing was affordable in Australia. Let me tell you what, they've been talking about it for a couple of hundred years in Australia, and they're going to continue to talk about it for a couple of hundred years in the future. I remember I renovated, and you spoke about the Smart Property Investment portfolio, Paul, which we're in the process of refinancing right now, and I've shared some of that on this podcast. The work I'm doing with finny.com.au, Finny Mortgages there, as a big start of it. So I'll do an update on that in time. But I remember renovating inside of that portfolio, a place in North St. Mary's, and I kept them. I ripped out the carpet, and from, I think it was probably the late 50s, early 60s, rather than using that foam underlay they use today, they used copies of, I think it was one of the local papers. It wasn't a Blacktown Advocate or what's the one out of Penrith? I can't remember. Penrith Leader, maybe? I don't know. Copies of the Daily Telegraph. But you flick through them, they're flogging houses, and the headlines all about how unaffordable Australian property is. I remember when my parents first moved into their house, they used a couple of deck chairs and a card table for the first 5 years because they couldn't afford furniture because they'd invested so much into their house with a picket fence, right? Really basic sort of Western suburbs house. So housing affordability is not a new thing. What does the history book say when we move into these markets, these interest rate markets which are going north, around the philosophy towards affordability, but also the psychology, most importantly, towards affordability and investing in property? Because, I see opportunities in this current market. I've been around property for a bit, and I've got a bit of scar tissue around it. So those smart investors will be operating in it. But is there any sense for what happens historically with mindset when it comes to rising rates?
Yeah, it's a key one, because I think you mentioned at the start of this too, Phil, is that 12 years ago was the last time we saw interest rates move north. And the reality is, if we're talking over 1 million mortgage holders who have never seen this environment or never had any exposure or experience in this environment, it's tough for them to get a bit of a narrative as to saying, well, I know what happened last time. here's what will happen this time. But I think for me, the big thing that is key, especially for the listeners, and I know there's literally over 100,000 listeners to this podcast every week and every month and every year on every episode that goes past, is the fact that we've got such good access to information to ideally allow people to perpetuate what the facts are. And, we're not out here saying that it's always going to be rosy or it's always going to be doom and gloom, but I'd like to think that what comes across now versus where people would get their information from 10 years ago is a lot more specific and factual that's actually going to apply to the Australian investment property market. Because I tell you what, if people close their ears and only open their eyes to the 6 o'clock news right now, they would sell everything that they own in preparation for what is going to be the worst year of their life financially. And the reality is it couldn't be anything further from the truth, where there's, as I was saying, there is more savings in bank accounts. We're further ahead on the actual facts of where our mortgage repayments are. We've got now entering into what will be the highest rate of wages growth cycle in a very, very long period of time, in addition to investors who already own property seeing the highest level of rental growth that they're probably going to see potentially in the entire time that they've held their asset base as well. And that's not going to happen for 1 month or 2 months. The problem that the Australian property market has, that's coupled with why inflation partly is going where it is we've got supply chain issues, we've got cost of labour going up, we've got cost of materials going up. And essentially what that's going to mean is that there's going to be less people buying Australian property to own and live in for a small period of time, which is only going to exacerbate the rental market which exists right now. So we've got this perfect scenario for any property investors who A, own property, or B, think they're going to buy property, to really understand the fact, say, hey, we're not going to a 7 or 8% interest rate environment. We're likely to probably enter into what is going to be a high 3 to mid 4 interest rate environment. And that's going to be coupled with what I expect is probably going to be a 2 to 4 year rental increase timeframe, which is unseen for a lot of property investors. They would look through the 10 years of rental growth that's occurred in basically any market. And if I say any market, I'll probably take out a couple of markets that I know we've bought in parts of Hobart, mid-2015, 16, Launceston, Devonport, Burnie. We bought a lot there sort of mid-15, 16, 17. And that's all probably 30, 40, 50% rental growth. Outside of that major city market, across Australia, we've seen very insipid rental growth over the last 15 years. And that's basically been because, and if you look at any indicative graphs of interest rates increasing, you typically see a correlation of rents increasing. But because we've seen this 12 years of decreased rates, we haven't seen the same inflationary pressure on rents. And that's only just going to start now. So one thing that I'm personally quite excited for, selfishly, as a property investor for quite some time, and I'm sure you'd be the same, Phil, is you're going to look at your portfolio. And this is the time that we should really be considering holding our property managers to account, and don't let people renew their leases unless we know that they've done a full market stress test and we understand where and what their market rent should be. And I'm not saying that we're talking about gouging our tenants, but we're talking about making sure that you put your rents where the market rent should be, because this is probably going to be one of the times where your cash flow will increase permanently across your portfolio.
Yeah, it sort of reminds me back to the early days of the COVID pandemic, where they put this mandated a reprieve for renters. You couldn't chuck them out. You couldn't increase rates, right? Or increase rents. And, and then you saw these militant nutters. This is a property investment show, so I'm happy to say it, sort of marching through the streets saying, yes, the evil landlords, let's get them quick. No one pay their rent because they're evil. I'm already seeing in some social media feeds those same people. And if you want to come and have a chat in a podcast, editor at smartpropertyinvestment.com.au, I would absolutely enjoy it, saying, yes, what we need to do is mandate it. They're not allowed to put rents up, the evil landlords, because of all the struggles us renters are having in paying our rents, right? Like, this is reality. It's a property investment podcast, so we can chat this way. But what you're talking about there, Paul, through the lens of property investment, I think is reasonable. And if you are a property investor and you're in the market, you've been in the market, this should be a reasonably good market moving forward. You're going to get that 10 years of pent up. It was easier to buy a joint than what it was to rent. Well, largely, right? If you get finance and stuff. So people are choosing to buy, which therefore put pressure on prices. Prices go up, etc. At the moment, people can't buy because prices are at a point where it's unaffordable for them, back to the affordability, and therefore they have to rent. We're not even throwing into this the migration component of it all. So for property investors, this is the point, the property investors in this market who are going to be the losers are the lazy property investors. They're either not doing these rent reviews that you're talking about, working with their property managers, or if they're self-managing, to push their rents up in line with where the market sits, or they're going to lose because they're being lazy around their mortgages. So they're not looking at their mortgages and not going, hang on a second, is this the right mortgage for me? Hang on a second, is this priced appropriately? Hang on a second, do I have the right features and benefits around this mortgage? Hang on a second, is my rate too high? So it's going to be one of those things. If you're lazy, you're going to lose, and that's going to define property investment over this next period of time.
Mate, you're exactly right. I think for me, that is the key. And that's going to be the theme for probably the next couple of years. I think we're really going to see the haves and have-nots who are already property investors, those who just think, look, I'm super passive with my portfolio and I do nothing with it. And essentially I trust my property manager. I'm not saying you shouldn't trust your property manager, but it's like anything. This is your small business. Every property is its own small business. And if you don't look under the hood when you should on a regular basis from things like where your mortgage rates are at, your loan structures, have you extracted the equity and the equity is available to ensure that you're prepared for opportunities that are going to come over the next few years, in addition to, is your revenue, i.e. your cash flow, the rent that you're charging, in line with what you should be charging for your goods and services, i.e. the accommodation you're providing a tenant. These are simple things, and they're not things that you have to do every day or every week or even every month or every quarter. They're typically something that you might do every 6 months or every 12 months, but you need to do it. And right now is certainly, probably over the last decade, is probably the key 6 to 12 months of people, reviewing where their mortgages are at, extracting the equity, making sure their loan structures are in line with what's going to get them the best, cheapest and most optimal cash flow. And secondly, making sure that they have the ability to make their rents in line with market rents. And probably the third thing that I'd couple with that, and it's probably partly to do with what I first mentioned I'm already seeing them now, probably in some of those overpriced markets, there is opportunities. But I would make sure that people are aware that don't expect that markets are going to fall. Don't expect as an aggregate that the Australian property market, that you're going to see every single market go back 5, 10, 15%. There are certainly markets. And if I look at literally the CoreLogic data that came out 2 days ago, you've got Perth as a market that increased by 0.045 a month, on track for a 15% capital growth for the annual basis in the residential sector. Adelaide in a relatively similar position. Brisbane in a similar position. You've got those 3 major markets, 2 of which have a population of over 2 million people and growing, with vacancy rates sub 1% and still decreasing, that are in a prime position for capital growth and for cash flow. So It is still going to be a normal market.
Yeah, I want to chat about that because I saw those same numbers. And if you look outside the capitals into the regional markets, the April 1% growth I saw just for sort of regional markets in New South Wales. So, it might not be going 5% a month, but 1% a month is largely a normal market. So hold on, everyone, don't get sort of swept up in it. But just to close the loop on this, and to my point around how investors can thrive in this market, rather than looking at it as a negative point of view, as in those will lose that. Those that will thrive will be proactive. They'll be reactive to market conditions and changing economic circumstances, and proactive in terms of how they choose to manage their mortgage. Look at the cash flow, i.e. what your rent's doing. Look at how you can add value to your asset, manufacturing equity, to capitalise on those rents. You might be able to shift it from a $350 a week property to a $425 a week property through a smart cosmetic reno, where you can get those materials that you need. So start looking at the cash flow. The capital growth, if you've bought well, will continue over time. It might not be accelerating at the same rate as what it does over the last couple of years, but if you bought well, hold on for that. But you got to get primary point. Get your mortgages sorted out right now. You might have some equity in there that you can refinance, chuck it an offset, because there will be opportunities coming up, and I want to chat about that. Speak to your mortgage broker. If you don't have a mortgage broker, go and find yourself one. I'm sure the guys over at finny.com.au are happy to have a chat with you. That's who I'm using to do my mortgages. But there are so many good mortgage brokers out there in Australia. 60+% of all mortgages in Australia now done by mortgage brokers. You don't have a relationship with the mortgage brokers, go and find one, give them your portfolio, say, sort this out for me. This is what I want to do. But Paul, buying opportunities. It's what you do for a living as a buyer's agent. I want to get stuck into that because I want specifics as well. So I'm going to hold you to task here. We'll just go to a break. When we come back, Paul's going to give you his hotspots. Back in a moment.
It's time to get help. Interest rates are increasing. Inflation has hit an extraordinary 5.1%, and the chance to secure a golden egg property is getting narrower by the day. Dragan from Buyers Agency Australia has been presenting the facts and helping property investors make smarter, well-informed, educated decisions in property for years. So, what are you waiting for? Get in touch with Dragan today at www.buyersagencyaustralia.com.au. Invest with integrity.
Welcome back, everyone. Phil Tarrant. I'm chatting with Paul Glossop from Pure Property Investment. Just went on my little narrative around getting your mortgages sorted out to capitalise in this market. I know the smart investors, Paul, myself included, getting set for some buying over this period of time, which is probably counter-cyclical to the way the rest of Australia, the non-investor mindset, are probably retreating and saying, I'm going to wait for the crash and then I'm going to capitalise on it. You're hearing all this stuff moving forward. There will be markets that will do well during this period of time. And if you're buying for the future, you start thinking about those sort of assets. I think development stock moving forward, you probably got less heat in the development market, so you might be able to pick yourself up some stuff in that regards. But Paul, what are the smart investors doing that you're seeing through Pure Property Invested at the moment? Where are they buying? What are they buying? And what's sort of their objectives with it all?
I'll start this part by probably just giving a tactical overview as to a client of mine who I started working with about 6 years ago. And this is probably one of the better news stories I've worked with since starting my business quite some time ago now. A client of mine came to me with 2 investment properties in Sydney at the time, and they bought them early 2011-12, and they did really well out of it. But the reality was at that time that they had increased with some equity, had a relatively average cash flow, and started to think, okay, I've got to push further out there. And the reason why I would give this information is because this is basically where I think people need to consider. That client since bought, I think they bought 8 investments with us over a 3.5-year period. And they range from prices as $250 right up to about $700K. And they range from Hobart, Launceston, parts of Brisbane, parts of Sydney again a couple of years back, and parts of Canberra, and one in Perth, I believe. My point with that story is that they actually recently, as of about 3 months ago, retired from their day job. They sold their 2 first investments, used that profit to pay down the majority of their investment portfolio. Their actual expenses didn't increase, and they ended up with about $107,000 annual income with about a $3.5 million asset base. And he was 46 years old. Awesome story, terrific person, and stuck to his guns as far as what he wanted to achieve. My point with that, and the reason why I highlight that, is that this is what the wise investors need to consider to keep doing, especially those people who are focused or have been focused or are based in potentially parts of Sydney or the broader Sydney metropolitan and even the East Coast New South Wales market, parts of the Melbourne market, broader Victorian market, also people who are in the Tasmanian/Hobart market. Not that that's a huge cohort, but there's a lot of people there with a lot of equity, but are now just starting to see the downward end of what this long and sustained growth cycle has achieved. The reality is that the smart investors are really now thinking, okay, well, my portfolio, if I am going to get to myself to a point of financial independence at some stage, I'm not going to be able to have every single property that sits in Double Bay in Sydney, or that's going to sit in the Turaks of Melbourne, or any of these areas that are in the respective premium markets across the capital cities. And the reality is I might not ever, and likely will never, have a property in those areas for investment purposes. But you don't need it to get the outcome. And the reality is what we always need to focus on is, what is the end goal? Where do we need to go to get both growth and cash flow to fit that criteria? And if I'm looking at, and I know you're going to press me in a second to say, well, where is that place, or where are those places? The reality is that they're not exactly hiding under huge, galoshes of the cloak that no one can see. These places are in plain sight, and they've been in plain sight for a long time. The key is patience. And these places still sit around Southeast Queensland. These places still sit around the broader Perth Metro. And I know, Phil, you personally bought recently in the broader Perth Metro. They sit in parts of even the broader Adelaide Metro and part of the South Australian markets. They sit in some of the major regional centres as well, because these markets, whether people want to go and visit them or have heard of them or ever consider living there or not, these markets are the engine room of what is going to drive both growth, drive cash flow, and they are grossly undersupplied currently. And that will remain the case for at least the next 2, 3, 4 years, and most certainly over the next 8, 10, 15 years. Because again, regardless of what happens over the next 12, 24 months or what happened in the previous 12, 24 months, if you're investing for a 1 or 2 year horizon, you shouldn't be investing in property. So you still got to have your eye on, where do I expect this market to be in 10 years plus? And is this going to fit my portfolio in 10 years plus?
So where are those places?
Well, mate, I just gave you 3. They were pretty broad. Do you want me to rattle off 1,000 different stuff?
Mate, Perth Metro, Adelaide Metro and Southeast Queensland.
Well, give me a budget. Look, if I had no exposure, I'll give you a hot tip right now. If I had no exposure to Brisbane right now and I had 500 to 700K to spend and I wanted to get my foot in the door in that market, as an example, I think on the lower end of that budget, there's going to be a handful of places in the broader Ipswich market, which I think are going to continue to do really well. That's probably seen 25 to 35% capital growth in the last 12 months, which sounds like it's at the top of its cycle. However, it's probably the first 12, 18 months of what is to be the first start of this growth cycle in 10 years.
It's been very sleepy. Very sleepy. Brisbane.
And it's only waking now. So don't be afraid if you look at previous 12 months of 30% growth, I think you missed the boat. People say the same thing about Sydney. If they didn't buy in 2015 after about 60% growth over the previous 3 years, well, guess what? It did another 70% between then and now. But the beauty of that market in general is you're getting around about 10 to 18% rental growth annually. So be comfortable with a $500,000, $550,000 property that's only got a $350 to $380 a week rent locked in, because the reality is that a lot of those rents were on 12 months ago leases. And these are some of the better buys, because people look at them as investors and think, well, that's a pretty rubbish yield considering. But be comfortable that the actual market rent for these properties is more like $450, $490 a week, which will go up in the next 12 months. And if I look at other places at the top end of that price point in that Brisbane market, the Moreton Bay region, and I've been a big proponent. I personally own a lot of property in Brisbane, but also lived there for a long time. The north of Brisbane in the Moreton Bay region, again, in that 550, probably not much available in that range anymore, but 600, 650, 700 even, there's still plenty of opportunity for good growth assets, good owner-occupied locations. Cash flow is probably a little bit slimmer than the West, but still plenty of opportunity for growth if you're looking for good, affordable corridors in that market. Further to Perth, same thing. Look, you look a bit more towards the south, southwest, towards the airport region. You've probably got about a dozen suburbs which sit right around that airport region. Further south in more affordable markets, if you've sort of got a budget of $450 down towards Mandurah, Rockingham, etc., you've got good coastal locations which have been markets. You're still buying property that was cheaper than where that property was trading at the peak of its market in 2012, 13. So put that in perspective, 10 years ago, those properties were still more expensive, and you've got a 2 million plus population, sub 1% vacancy rate, sub 4% unemployment, strongest household income versus mortgage commitment capital per capita ratio in the country, and you're still buying property cheaper than what it was 10 years ago. So I can give these examples across the board, but there is opportunity there that will still provide good growth, good cash flow for the next 3 to 5 years, hands down.
Okay, that's reasonable. I'll give that answer.
It's a B minus.
7 out of 10. That's what's 7 out of 10 would be a B. I'd give you a B. Should be a B. Should be a B plus. But let's, like, when you look at these areas, you're talking about sort of owner occupied stuff. So no doubt you're talking houses, right? You're talking houses as investment
predominantly,
stock, rather than units. Predominantly.
Yeah.
What should you be? And my point, I've been chatting about this. I think the sort of balance of power is starting to move back in the hands of the buyer's agent in these markets. That said, Brizzy's still pretty hot stuff. But this whole notion of, there will be, or there should be, normalised capital growth in these markets over time. In Brizzy, you might get some accelerated stuff, a bit of a hangover from what hasn't happened over the last sort of 5-6 years there. But what should you be trying to find? Should you be looking for finished stock where you just buy it and look for an uplift on the rents because the rents are low and that might be the arbitrage uplift you get? Or should you be looking at, renovators' delights where it might need a coat of paint and a new kitchen? Should you looking for something where more structurally orientated, where you can bang out some walls or put an extension on and add another couple of bedrooms? Should you be looking for stuff that can be developed or knocked down and put a duplex on, or all in sundry? It's got to depend on where you are with your portfolio. How would you answer that?
Yeah, it's a really good question, Phil, because I talk about that a lot with our clients typically when we have initial meetings to say, what's the borrowing capacity and liquidity, and B, what's the propensity to want to take on these things, because they're not exactly free money. And regardless whether you just want to do a quick freshen up or a full shebang of a knockdown, develop, submit to council, look for a 1 into 3 subdivision, they're going to take your energy tickets to do so. And for me, the big part is, some people are most people are typically just far too saying, look, I'm investing in property because I want this to be something that I look back in 10 years for the most part, say, I made some good money. It cost me very little, gave me very little frustration. To be active in this space, properly active, I think is probably one of the riskier times personally to consider buying renovating and trying to extract equity in that format. Because right now, what we've got, and we've spoken about already numerous times today and also in previous podcasts, is that we've got the biggest issues we've ever had, or probably at least in the last 10, 15, 20 years, with labour costs, material shortage, and time to essentially get things done when we're talking even just basic fresh nuts for basic tradespeople right through to skilled workers, and then all the way down to things like, if you're talking getting structural things in place, be it steel, be it engineers, be it town planners, be it submission to council, regardless, you have got the more delays in that space. And I actively develop property and I'm experiencing it across the board firsthand, is that unless you are well experienced and you know what you're doing in that space, for me, the quick wins are buying properties which are tenant ready. And the beauty about buying properties, and I'm not talking about a fully renovated property, I'm talking about a property that is structurally sound, neat as a pin, and move in, other than a good old fashioned scrub and maybe a couple of bits and pieces that a good handyman could go in and spend a day just sorting out. That's where the wins are, because what you're able to then do is that you're able to leverage the sub 1% vacancy rates to be the things that are going to increase your rents. You're not using your money or your ability to actually go put your time into renovate this house to increase the actual rent value on these properties. So they're the things which I think the smart investors are considering and being aware of, is that as much as there will always be an opportunity to add value, now for me, for the most part, wouldn't be the time to physically put in either your labour and or your cash to increase the rental value of a property, because ultimately the market is going to do that for you. So buy something that's ready to move in, barring a couple of basic updates and a tidy up.
Okay, that's good counsel. So Paul, who knows what's going to happen in about 2 hours' time when the RBA meets. I've got some views on it. Whether or not I want to put them on air right now, because I might be proved wrong in two hours' time.
How about you have a crack, Phil? You have a crack. You always put me on the spot. I'm putting you on the spot. Give me, what do you think? What do you think? I'll give you my mail after you give me your mail. It might be well in line with you.
I reckon.
This is interesting. I don't think we've ever done this. This is Nostradamus, 1.5 hours, T minus stuff.
I reckon we will be moving into a rising rate environment. Will it happen today? It's not 100%. I think the Reserve Bank of Australia has always been quite considered and conservative. We only need to think back to, last year, and they were talking about interest rate hikes in 2024, right? We're only in 2022, May 2022 at the moment. You still haven't yet seen, we're not going to see it handed down for another couple of weeks, the wage data, whether or not we actually have seen that growth in wages. The RBA has been pretty clear that they won't tinker with rates until they're confident that there is wage growth. And then if you sort of overlay that with a lot of the uncertainty in this market right now, which is outside of the control of the RBA, and it comes back to sort of economics lessons, you start making it even more expensive for Australians to live. You're looking at CPI, so a basket of goods, which includes housing, and rents. Rents going up. Okay, cost of goods are going up. Some of it is a result of supply chain constraints, and buying a house is more expensive. So if mortgages go up, the idea is that's supposed to slow down people's spending to reduce the upwards pressure on rates. But a lot of that stuff is completely out of our hands. I've spoken about it before on this podcast. Mate, there's literally thousands of boats off the coast of China waiting to go in there to dock to pick up stuff, right? The reason why there is inflation, and a lot of it is a result of global economic factors, which are pushing the price of goods up. So whether or not the government intervening right now would be the RBA to intervene now is the most appropriate thing, because there's so many what ifs. It's not guaranteed a rate rise today. It's not guaranteed.
Nice one, Phil. That was straight out of the playbook of Albanese and also ScoMo, mate. You spoke for 4 minutes and said nothing. Thank you for that. I'm going to put it out there. I'm going to say what I reckon you'd want to say, is that I personally agree, and I think a much slimmer chance of a rate rise today than there is in June, depending on what comes out of the wage and the wage discussion.
Yeah,
we just haven't got that data yet.
We haven't got that data yet, and the Reserve Bank is traditionally very conservative around these type of things. So, I think the banks, like who benefits from rate rises, right? The banks.
The banks.
The banks win. So, mate, they're banging a drum. Of course they want a rate rise. They want to accelerate this as fast as possible. It's good for shareholders. And most of us hold some bank stock somewhere, so we're going to win somewhere along the line. But the banks benefit from it. And whether or not it recalibrates the speed of inflation, I guess the economy benefits from it as a tool. Interest rate rises is not a negative thing. You've spoken about it. Like it's a view at a point in time of economic performance. So like it's okay, Australia, that rates are going up. Mm-hmm. But yeah, I'm leaning towards that way at the moment. We just still, the data's not there, but the banks want to rate it. The issue is it's been weaponized, politicized, the rate environment right now. And this is sort of connected in with the whole affordability stuff, but it's been weaponized by political pundits, as in saying the Reserve Bank is completely independent of who's in power. And that's one of its benefits, right? It's part of the government apparatus and the bureaucratic apparatus that governs the nation. But irrespective of who's in power, the Reserve Bank of Australia should be making its decisions without economic influence. That the question is, people are saying, if they don't do it this time, it means it's giving a bias to the coalition government as we near an election. And whether or not you believe in that, it's irrelevant, but it is getting weaponized. So there are people who are using it and trying to beat it up, which the media picks up on. But who knows? Who knows? I know I'm going to do an update with you tomorrow.
On Wednesday. Yeah, I think or tomorrow, Wednesday. Yeah.
Yeah, around see what happens and whether or not we're wrong. But you know what? Irrespective, and if rates do go up today, I won't go back and cut this bit out. I'll leave it in here because
for sure. Because the way it works. As you said, Matt, I think it's definitely not a foregone conclusion. And if anyone wants to get a bit of a history lesson through this, and I think I spoke to you about this a long time ago, Phil, but there's a great little website. Well, it's part of the asx.com.au website that they do a rate tracker, and essentially they do a polling every month prior to, and they get a bit of a sense as to a change to no change. And over the years, I think they've got data on that over the last 15 years. They go back to basically getting a polling of about 100 odd economists, and they essentially get their opinion, yes or no, and it gives a percentage. And if you look back, it's actually quite accurate. And if I look at that as we speak right now, as of trading day, the 2nd of May, 74% of those polled have said that they expect no change, 26% expect an increase to 0.5%. So it's a 3 to 1. So
and is that for today, or is that for like 0.5?
That's as of today. So they do it every trading day. So that was today. If I go back to the 29th of April, 64% expected no change, 28th, 61% expected no change, 27th, 58% expected no change, 26th, 83% expect no change. So you can kind of see there that they poll it daily. So they get a good view, because obviously data comes out daily, and more times than others, there's more important data which changes perception.
So the economic boffins, so those people who probably got vast degrees and learnings around this, are saying no rate rise today. So what it's saying?
Yeah. Essentially saying 74% say no change today. That was polled as of yesterday.
Okay.
Which is interesting. And anyway, look, I mean, regardless, this is where we are, and we'll be proven in the best part of an hour whether this goes this way or not. But this will get out in airwaves in a few days, and people will take their judgments. But again, look, regardless, as we've said this entire podcast, regardless of the outcome of this decision, the only person or only people rather who are going to benefit from this in the probably short to medium term, realistically from a numerical value, are going to be the banks, where their margins just get a little bit better. But as I've tried to demonstrate with some of the previous historical data, is from a property perspective, there's going to be winners and losers. And that is going to, regardless of whether it changes today or next month or next year, this is going to play out the same way it's played out over the vast decades that we've seen this data come through for property.
Yeah. And look, the sage point here is that interest rates increasing to decreasing are going to come and go. That's the nature of the markets. And if you're operating as a property investor, you've got to be used to that, those things that are out of your control. However, and we've been chatting about, I've been banging on about it for years on this particular show, the Smart Property Investment Show, that you should be building a portfolio that can withstand market conditions, irrespective of what they are. Who telegraphed the COVID-19 pandemic back in 2019 as we entered in 2020? My portfolio has been okay through that. I have not at any point in time, even at the depths of how bad, that half of the world was going to die as a result of COVID. Our portfolio, Smart Property Investment portfolio, is held firm the whole way through it. There's never been at any point in time where it was really in any sort of distress. And that's because it was built the right way. It was built for the sustainable future. It wasn't built for today. It was built for tomorrow. Well, guess what? Tomorrow always comes. And this is another movement in markets? Will it be the seismic shock that we saw at the initial part of the COVID? I very much doubt it. But guess what? There's going to be stuff like that in the future. So make sure your portfolio is built so you can sustain any changes to the market and, most importantly, capitalise from it. And that's what the smart investors are doing right now. Paul, thanks for coming in and sharing some of those views and vision for the future. As you've dusted off the annuals of the history books, maybe if you were, I can't remember his name, the Back to the Future dude with his red puffer jacket, Jamie Foxx. What was his name on? Not Jamie Foxx. Michael J. Fox. Marty McFly. So if you went back in time and got the almanac, and you had to sort of beat up Biff with it when he become emperor of the world because he nicked it out of that bin back in the 60s. If you could get the property almanac May 2022 and took it forward in time to 2032, what are you going to do over the next year?
Mate, that's a good one. That's a good one. It's I think back then he said to go back to the beginning of the season, put some money on the Cubbies, right? Because the Cubs have never won the World Series, and I think that only happened about 5-8 years ago. I'm going back through my Major League Baseball almanac in my brain, which is pretty average. But to that point, if I'm buying now for the almanac of what I expect is going to play out in the next year or two, I'm still buying in Brisbane. I'm buying in Perth. I'm probably buying in Adelaide for that matter. And I'm buying in a couple of probably about 15 separate major regional markets, top 50 regional markets that we've got across Australia right now, and still focusing on probably for the most part sub $600,000-$700,000 properties, because these are going to be the properties which people are going to be able to afford, people are going to be able to rent. And as much as we're going back into this norm of sort of this hybrid work from major centres, work from home, that's going to be a bit of a common blend. So there's going to be some opportunities as well in those markets, because some of those very expensive markets, i.e. the Byron Bay circles, the Noosa circles, probably not Noosa so much because it's probably got a bit more of a smaller market, but there's going to be some opportunities in the next 2 or 3 years too. So if anyone wants to pick up a lifestyle property, keep your powder dry, in my opinion, because a lot of those lifestyle areas which people went and bought potentially a very expensive property in an area that's got a lot of available second and third properties, I expect they'll get a little bit cheaper.
There you go. All right, Paul Glossop, Pure Property Investment. Thanks for your time today. Remember to check out smartpropertyinvestment.com.au. We'll keep on this over the next period of time as the double whammy of, triple, quadruple whammy of hiking inflation, rising interest rates, higher costs of living, and the federal election all sort of snowball into the one collective story. So stay tuned, stay engaged. Social media, Smart Property HQ is where you'll find us. Please keep those reviews coming wherever you listen to this podcast. Most of you guys and girls on iTunes, our team get a kick out of it. Thanks for your time. See you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
It's safe to say the property market has been red hot over the last few years, with some of the markets we've selected in 2021 rising over 40% in a 12-month period. It's very likely that if you're a property owner, your property has gone up 20% minimum in value in the past 12 months, and you have most likely accrued sizable equity that can be recycled and extracted to build your investment portfolio. With interest rates increasing, you might be wondering where to invest to maximise capital growth and cash flow in 2022 and beyond. Well, to save you time, energy and guesswork, award-winning author and regular guest on the Smart Property Investment podcast, Paul Glossop and his team at Pure Property Investment have outlined the top 30 affordable suburbs poised for strong capital growth over the next few years with sound cash flow. Grab your free Top 30 Guide to Property Investment guide today at purepropertyinvestment.com.